Okay, let's dive in. You might think financial success is all about complex math or, I don't know, some secret stock picking trick.
Right. Like having a PhD in finance is the only way.
Exactly. But what if it's really more about, well, behavior, how you act with money?
Uh-huh. It's fascinating. You hear these stories, right? Like the super wealthy executive throws cash around, seems brilliant,
Yeah, like that hotel manager
and
story.
then poof, they're broke. It happens.
But then you get someone like Ronald Reed, a janitor,
Yeah.
gas station attendant.
Yeah, not exactly Wall Street material on paper.
But he quietly invests, lives simply, and ends up leaving millions to charity. It's a stark contrast.
It really is. And it suggests that maybe the mechanics, the technical side of finance, that's only part of the picture. Maybe not even the most critical part.
Right, and that's really what we're digging into today, this whole psychology of money. The sources we looked at, they really emphasize how our own unique life experiences, they just profoundly shape our financial decisions.
Yeah, it's not like, say, medicine, where there's often a clear best practice based on science.
Huh.
With money,
It's personal.
it's incredibly personal. Your background, your fears, your hopes,
Mhm.
they all color how you see risk, how you make choices. It's deeply ingrained.
So our mission here in this deep dive is to pull out those key insights. How does personal history, how does risk perception, how do all those, well, sometimes irrational human tendencies affect our financial lives?
And you have to wonder how much of your own financial worldview is just shaped by the tiny slice of history you've personally experienced.
It's wild, isn't it? Someone who grew up, say, with really high inflation,
Like in the 70s, yeah.
they're going to have a totally different gut reaction to rising prices than someone who mostly saw low inflation, like in the 90s or 2000s.
Absolutely. Or think about risk tolerance. Someone whose family struggled financially versus someone who grew up comfortable.
Completely different starting points, emotionally, experientially.
And there's research on this.
Mm.
Ulrich Malmendier and Stefan Nagel, they look at investors over years.
Uh-huh. At the National Bureau of Economic Research.
Right. And they found that your willingness to take risks, it's not mainly about intelligence or education. It's heavily, heavily influenced by the economic conditions you personally lived through.
Wow. So it's really about what you saw and felt.
Pretty much. Even when you were born matters. Bill Gross, the bond king,
Yeah, legendary.
he himself admitted part of his success was just being born when interest rates were generally falling for decades. That created a huge tailwind for bond investors.
So timing and luck play a role. A big one,
A
maybe.
huge role. It doesn't mean skill isn't important, but you
Mm.
can't ignore the context, the backdrop.
Right. And this helps explain some behaviors that seem irrational on the surface, maybe? Like why someone with a low income might buy lottery tickets.
Exactly. Mathematically, it's a long shot, obviously.
Hmm.
But if your opportunities feel really limited,
That ticket might represent the only glimmer of hope, a chance to dream, even if it's slim.
it's understandable from that perspective, even if it's not rational in a textbook sense. It speaks to a deep desire.
Okay, so this personal history lens is powerful. Let's shift a bit. This whole idea of retirement, it's actually pretty new, isn't it?
Relatively speaking, yes.
Hmm.
Before World War II, the norm was basically work until you couldn't.
Wow.
The idea of saving enough individually to fund decades of retirement, that's really only become widespread in the last couple of generations. Think 401ks, IRAs, they haven't been around that long.
And that puts a lot of responsibility on individuals now, doesn't it? To figure out saving, investing.
It does. And it's complex. Robert Shiller, the Nobel laureate, he points out there's so much we just can't know about investing's future.
So luck, good and bad, plays a part in how things turn out for us.
Definitely. Which means judging your own success or failure just by the outcome. It's not always fair. There's so much randomness involved.
Yeah, I read about that research, Bhaskar Mazumdar, looking at brothers' incomes.
It shows how much things like family background, things outside your direct control, influence outcomes. But people often struggle to see that in their own lives.
We like to think it's all us, right? Our skill, our hard work.
We do. Look at Cornelius Vanderbilt.
Yeah.
Incredible success, built empires.
But walked a fine line, ethically, legally.
Exactly. Was it genius? Boldness? Or was it reckless risk-taking that just happened to pay off? It's hard to disentangle.
Yeah.
And can you even replicate that kind of extreme success?
Probably not. Maybe it's more useful to look at the average experience, like Frederick Lewis Allen suggested, learn from broader trends.
I think so.
Huh.
Studying the outliers is fascinating, but the lessons for most of us probably lie in understanding the more typical financial journeys.
Speaking of outliers, That anecdote about Kurt Vonnegut and Joseph Heller at the billionaire's party?
Oh, yeah, that's a classic.
Heller points out he has something the billionaire host might never have.
The knowledge that he has enough.
Enough. Such a simple word, but so powerful,
Mhm.
and apparently so hard to achieve for some.
It really is.
Yeah.
Think about the people who had fortunes, people who had everything they needed.
Like the LTCM traders? Or Rajat Gupta.
Exactly. They risked what they had and needed for something they didn't have and didn't need. More money. And they lost things far more valuable.
Reputation, freedom, relationships.
Yeah.
Happiness, things you just can't put a price on.
Never worth the risk.
Yeah.
Comes down to knowing when to stop chasing more, when to just say, this is enough.
Okay, so knowing enough is key. Let's talk about building wealth over the long haul. Compounding.
The magic of compounding. It's like the analogy they use about ice ages.
Right, tiny changes. A little bit of snow sticks around each year.
And over millennia, you get glaciers miles thick. It's the same principle with investing. Small, consistent gains over a very long time.
Can lead to massive results, like Warren Buffett.
Precisely. His secret isn't necessarily hitting home runs every single year with astronomical returns. It's consistently good returns, compounded over decades and decades. He started young.
It's amazing. Someone like Jim Simons at Renaissance Technologies might have way higher average return.
Phenomenal returns, yeah.
But Buffett's sheer time in the game, starting so early, means his overall wealth is staggering.
It really shows how our brains aren't wired for exponential growth. We think linearly. We underestimate what time and consistency can do.
So, if compounding is the goal, what's the key to letting it work?
Survival. You have to stay in the game.
Getting wealthy and staying wealthy are different skills.
Totally different. Look at Jesse Livermore versus Abraham Termansky. Both got rich in the 1920s boom.
But after the crash, very different story.
And Livermore lost it all, tragically. Termansky, presumably, managed to hold on to his wealth. Staying power matters.
Michael Moritz from Sequoia Capital said something about their success being rooted in fear.
Yeah, the fear of going out of business. That constant focus on survival, on not blowing up, because compounding needs unbroken time.
And surviving means weathering the storms, the inevitable downturns.
Which is where things like just having cash reserves become so important.
Seems boring, cash just sitting there.
It might seem boring. It's not earning much, but it prevents you from being a forced seller of your long-term investments when the market tanks. That's invaluable. Selling at the bottom can devastate your long-term compounding.
So survival lets compounding do its work. Okay, planning. We need a financial plan, right?
Absolutely. But the most important part of any plan.
Let me guess. Plan for it not to go according to plan.
Exactly. The future is fundamentally unpredictable. Just think about the last 20 years. 9/11, the 2008 crisis, a global pandemic.
Nobody saw those coming, not specifically.
Nope. So a good plan isn't one that predicts the future perfectly. It's one that accepts uncertainty and has room for error built in.
A margin of safety.
A big one. The more your plan relies on everything going just right, high income, high savings, high returns, consistently, the more fragile it is.
You need a plan that can survive reality, basically.
Right. And reality often involves setbacks. Failure, even.
Like Walt Disney's first animation studio going bankrupt.
Perfect example. Early failure doesn't preclude massive long-term success. Often, it's a prerequisite. You learn from it.
So we need to be okay with things not always working out in the short term.
And understand the role of tail events. Those rare but massive impact events.
It's like in venture capital, where one or two investments make up for all the losses and generate all the returns.
Exactly. Or even in the broad stock market. Research shows a surprisingly small number of stocks drive most of the long-term gains.
So missing out on those few big winners or getting wiped out during a crash can really hurt your overall results.
Dramatically. Which again emphasizes why staying invested is so crucial, like Sue in that example.
Who just kept investing through thick and thin.
Versus Jim and Tom, who tried to jump in and out, timing the market. Sue did way better.
It's like Jeff Bezos said about Amazon needing big failures to find big successes.
You have to experiment, you have to risk failure to achieve breakthroughs. And in investing, as George Soros said,
It's not about being right or wrong all the time.
it's about how much you make when you're right and how much you lose when you're wrong. Managing the magnitude is key.
Okay, let's switch gears a bit. What's the point of all this money stuff? What does it actually buy us?
Well, research by Angus Campbell back in the day found that happiness isn't just tied directly to income levels, especially beyond a certain point.
Right. More money doesn't always equal more happiness.
But what money can buy, and this seems to be its highest dividend according to the sources, is control over your time, options, independence.
Ah, that resonates. I remember that awful investment banking internship I did.
High pay, I imagine.
Oh yeah, great money for an intern,
Hmm.
but zero control over my life. Miserable hours, doing work I didn't care about. And a powerful lesson.
It really clarifies the value of autonomy, doesn't it? Having choices about how you spend your days.
Definitely. Like Derek Sivers, who found that achieving financial independence early was more impactful than making much more money later, but with less freedom.
It's an interesting paradox, isn't it? The U.S. is one of the wealthiest nations.
But Americans report high levels of stress and worry.
Yeah, often higher than the global average.
And that long-term Harvard study on adult development.
The 75-year one.
That's the one. It consistently found that the quality of relationships and having unstructured time were far more important for long-term happiness than money or career achievement.
Fascinating. And what about that man-in-the-car paradox?
Right. You buy the fancy car thinking people will admire you.
But what they actually admire is the car, and they imagine themselves in it. They're not really thinking about you at all.
Exactly. So using wealth to show off often misses the mark. What tends to earn genuine respect?
Humility, kindness, empathy.
Things money can't buy. Which leads to that distinction between being rich and being wealthy.
Rich is high income, maybe flashy spending, visible.
Wealth is what you don't see. It's the income not spent, the assets accumulated. That's what provides the foundation for independence and options.
Okay, so wealth is built by not spending. How do we actually build it then? Is it all about earning more? Or investing genius? Surprisingly, maybe not. The sources really emphasize the savings rate.
How much you save out of what you earn.
Yeah. That often has a much bigger impact than your income level or your investment returns. It's the factor you have the most direct control over.
Like the energy crisis analogy, efficiency mattered as much as finding new oil.
Exactly. Boosting your savings rate is like boosting your financial efficiency. And you don't always need a specific goal for saving.
Just save. For saving's sake.
Kind of. Save because the future is uncertain. Life throws curveballs. Savings provide a buffer, flexibility, options. It buys you resilience.
That makes sense. Control over time, options. That seems increasingly valuable.
Definitely. Now, this ties into being reasonable versus strictly rational.
Okay, what's the difference?
Well, pure rationality is like a spreadsheet. Cold, hard logic. But we're humans. We have emotions. Sometimes doing the purely rational thing feels awful or it's hard to stick with.
Like the fever analogy. A fever might be biologically useful somehow.
But we treat it because it feels terrible and can be dangerous. Similarly, a financial strategy might be mathematically optimal.
Like using tons of leverage.
Right. But the emotional stress of potential losses makes it unreasonable for most people to actually live with.
So reasonable means finding strategies you can actually stick with that let you sleep at night.
Exactly. Like Harry Markowitz, the father of modern portfolio theory. His own initial strategy. A simple 50-50 stock-bond split. Why?
To minimize future regret and emotional consideration, not purely mathematical.
Precisely. Or maybe doing work you love helps you endure the ups and downs needed for long-term investing. Or having a tiny fund money account for speculative bets keeps you from messing with your main portfolio.
Reasonable, even if not perfectly rational by the textbook, like Jack Bogle investing in his son's higher fee funds.
Yeah, driven by family connection, not just lowest cost. It's about finding what works for you long-term.
Okay, so reasonableness trumps pure rationality sometimes. What about using history as a guide? We look at past market returns all the time.
We do, but there's a danger there. The historians as prophets fallacy.
Thinking the past perfectly predicts the future.
Right. Finance isn't like geology or medicine where underlying principles are relatively stable over eons. Markets evolve, structures change, innovation happens constantly.
So relying too heavily on, say, data from 100 years ago might be misleading today.
It could be. Things are different now in many ways. Think about the rise of 401ks, index funds, venture capital, algorithmic trading. The landscape changes.
So recent history might be a slightly better guide, but still not perfect.
Probably. You have to be cautious with that phrase, it's different this time, but also acknowledge that sometimes, well, it is different. Look at Benjamin Graham. He adapted his value investing approach over his career as markets changed.
It all comes back to humility, doesn't it?
Absolutely. Investing requires confidence, but also deep humility, recognizing you don't know the future.
Like a blackjack card counter. They know the odds are in their favor long term, but they can still lose any given hand.
Exactly. You need that margin for error. It's not just being conservative. It's essential for survival. It allows you to endure setbacks and stay in the game long enough for the odds, or compounding, to work for you.
So maybe assume future returns will be lower than the past, just to be safe.
That's one way to build in that buffer and avoid excessive leverage like the plague. Leverage turns normal volatility into potential ruin.
Maybe that barbell strategy makes sense. Keep most assets super safe, take calculated risks with a smaller portion.
That can be a reasonable approach for many. It balances safety with potential growth. Ultimately, it's about getting to that point where you can do what you want when you want.
For as long as you want. Infinite ROI on that.
Infinite ROI. And planning for the unexpected is key to getting there.
Which brings us to another psychological quirk. The end of history illusion.
Ah, yes. The idea that we've pretty much finished changing as people.
We think our current values and priorities are how we'll always feel, but we underestimate how much we'll evolve.
Massively underestimate it. Daniel Gilbert's research shows this clearly. We're poor forecasters of our future selves.
Like that story of the friend who achieved his huge career goal.
And then found he wasn't actually happy because who he was had changed by the time he got there.
So how does this affect financial planning if we don't know who we'll be in 20 years?
It suggests avoiding extremes.
Yeah.
Don't sacrifice everything today for a future goal you might not even want when you get there. Aim for balance along the way, moderate savings, some free time, strong relationships now.
And be willing to abandon old goals. Sunk costs.
Definitely. Don't keep pouring energy or money into something just because you started it long ago if it no longer fits who you are. Kahneman's no sunk costs approach. Be willing to change course.
Okay, so we change, plans change. What about the cost of investing success? It's not free, is it?
Not at all. There's a price. And it's not just fees. It's volatility, fear, doubt, uncertainty, regret. That's the fee you pay for potential long-term returns.
And trying to avoid paying that fee, like trying to perfectly time the market.
Often leads to worse results. Like GE trying to smooth earnings ended up being destructive. Or look at stocks like Netflix or Monster Beverage. Huge long-term winners.
But incredibly volatile along the way. You had to have serious conviction and stomach to hold on.
Exactly. Those downturns, that volatility, that's the fee. It's not a fine for doing something wrong. It's the cost of admission for good long-term returns. You have to be willing to pay it.
Okay, let's touch on bubbles. They seem to happen periodically. Why are they so hard to learn from?
Well, partly because people rarely agree on what caused them or who was to blame afterwards. The narratives differ.
And is participating always irrational?
Not necessarily, especially for short-term traders just playing momentum. If you think you can get out before the crash, it's a risky game, but the incentive is there.
And seeing others get rich quick. That must fuel it too.
Oh, massively. Social proof is powerful. And just seeing others spend lavishly can distort our own expectations, even if they're playing a totally different financial game than we are. It can lead to keeping up with the Joneses and overspending.
Makes sense. Now, why does pessimism seem so much more compelling than optimism, especially with money?
Several reasons, probably. Pessimism often sounds smarter, more intellectual. Oh, they see the risks others miss.
Yeah, optimism can sound naive.
Right. Also, bad news often feels more urgent and affects more people directly. A market crash hits almost everyone's portfolio, or at least their psyche. Slow, steady progress doesn't grab headlines the same way.
Like that Russian professor in 2008 predicting global collapse got tons of attention.
Exactly. Even though he was wrong in the extreme. Optimistic views, like maybe how Japan recovered after WWII against all odds, get less airtime. Progress is slow. Setbacks are fast and loud.
Hans Rosling said people think the world is more frightening than it is.
He did. We focus on the dramatic negative, even if the long-term trend is positive. Think about early skepticism about airplanes versus their eventual impact.
That alien thought experiment is useful here too.
Right. The alien sees Times Square during a crash, sees panic.
But misses the underlying productive capacity. The buildings, the infrastructure, the knowledge, which are all still there.
Exactly. Narratives can overwhelm the underlying reality, especially when stakes are high and information is incomplete. We crave stories to make sense of things.
Like historical medical practices that seem crazy now, or the Madoff scheme. Compelling stories drew people in.
We're storytelling animals. We build narratives constantly to understand the world. And in fields like finance, which are inherently uncertain, unlike, say, physics.
Those internal stories, those beliefs, play a huge role, much bigger than just looking at the data.
But the alien only sees the data. Humans see the story. And sometimes the story is wrong.
Okay, so bringing this all together, what are the big takeaways, the actionable stuff?
Well, first, realize you're normal. Everyone's a bit weird with money because we're all shaped by unique experiences and emotions.
Less ego, more wealth. Saving is the gap between ego and income.
Exactly. Think of money as buying future calm, future options.
Save. Just save. For the unexpected. Define the cost of success, volatility, doubt, and be ready to pay it.
Worship room for error. That margin of safety gives you endurance. Avoid financial extremes.
Remember, you'll change. Plan for it. Don't beat yourself up for liking nice things. That's okay too.
Use money to gain control over your time. Be nicer, less flashy, earn respect that way.
And crucially, don't risk what you have and need for what you don't have and don't need.
And finally, manage your money so you can sleep at night. Peace of mind is the ultimate goal.
Your parents' story sounds like a great example of this, living below their means.
Yeah, achieving independence, allowing my dad to leave a job he hated. That was the win, not maximizing every last dollar.
And your approach too, keeping lifestyle stable, prioritizing independence.
Trying to. It's about being happy, not just being right, according to some spreadsheet. Sometimes those are different things.
Okay, so a final thought for listeners to chew on. How might your own earliest money memories, maybe things you haven't thought about in years, still be quietly shaping your financial choices today?
Yeah, or maybe ponder this, that what does enough really truly mean to you? Not a number, but a feeling, a state of being.
Yeah.
And are your daily financial habits actually moving you closer to that,